first payment of $1,603, $213 goes to the principal, $396 goes to interest. This is known as the Elwood tables. The Elwood tables are very heavily laden with interest, and the banks know this. Matter of fact, this loan, if you'll come down to month number 123, which is over 10 years into the loan, at month number 123, 124, your payment, actually more of it goes toward principal than toward interest. So 10 years and 2 months into a 30-year mortgage, it's heavily laden with interest, less laden on principal. Does that make sense?
Yeah.
Banks know this. Banks also know that most homeowners are either going to sell, which means they're going to buy a new home, or they're going to refi their existing home within 7 years. So guess what happens? These Elwood tables start back over again, and you're at the top paying the heavily laden interest. Banks know this. That's why they have the big fancy buildings. So if you want to properly pay off your mortgage early, here's a fun little secret. Let's say that I had an extra $600 a month that I wanted to put toward my loan. Typically, and let me get over here to the computer, typically what most people will do, they will just send in an extra $600 with their payment. And what the bank will do with that $600, they're going to take it off the bottom of the loan, okay? So that payment right there, I've erased that. So basically the last two payments, I don't have to make a payment. Or the last payment, I don't have to make a payment. They've taken it off the bottom of the loan, okay? The proper way to apply that $600 is to do this. Okay, let's say payment number one. Let's say that I made this payment in April. So I just made payment number one on this loan, okay? And so that payment, $610, $213 goes toward principal, $396.23 goes toward interest.
Wow.
I'll take that same $600 and I'll do this. I'm going to pay principal payment number 2, 3, and 4. So let me add those up right quick. So extra principal payment equals that plus that plus that. Okay, so I send in an extra $645.14, okay? I'll send that in. Now when I do that, instead of the bank taking it off the bottom, I'm also sending in a letter, and I'll make this letter available to you guys if you want it. And I'm telling the bank, hey, with this extra $645.14, I want this applied toward principal payments number 2, 3, and 4. Okay? You send in an extra check to the penny, so that means you have to know exactly where you are in the amortization schedule, and you send in the letter stating that you want this payment applied to these 3 principal payments. In doing so, this is how much interest you saved. Now I don't have to pay that interest plus that interest plus that interest. I've saved almost $1,200 in interest by paying it the way I want to pay it instead of letting the bank take it and take it off the bottom. So with that same $600, I've saved $1,200 worth of interest. Never will I have to pay this interest to the bank, and never will this bank collect this interest from me. So if I do this every other month or once a year or however often we may have the extra money to do it, we can effectively turn a 3.5% interest loan into a 0.5% interest loan. Okay, but what the banks will do, they'll take it off the bottom because it's more advantageous for them to take it off the bottom. We tell them where we want to take it off from. Now the cool thing about this, next month in May, when I make my May payment, I'm actually making payment number 5 on the amortization schedule. So I have skipped 3 months worth of interest that I will never have to pay. Now my May payment, I'm actually payment number 5 on the amortization schedule. Does that make sense? Any questions about that so far? I'm going to point out one more thing.
Do you have to designate that next payment that it's May's payment, or
You do not. You do not. You just send it in online portal with your coupon, however you would normally do it. And since you've already reduced 2, 3, and 4 down, obviously the next payment in line is your principal and interest on May payment number 5.
So you only have to designate the ones that are extra?
Yes, you have to designate the ones that extra. You have to send in a separate payment. I say don't do this online because the online portal doesn't give you an avenue to do an extra payment like this. You send a physical check into the bank along with that letter. Hey, with this extra $645.14, I want this applied toward principal payments number 2, 3, and 4. And they have to do that. They have to do that. Ms. Dolores, you've done this for years, haven't you?
Absolutely.
That is the way you apply extra money. And if you've got $500, well, you just pay off 2 of them and you're up to $429.47. You don't have to spend your full $500, but to the penny, send in that check and tell the bank how you want that money applied towards your mortgage. It'll save you tons of interest. So the question was, Joe had asked, and another lady that was here earlier used to work at a bank. So let's say, I think, and Joe, if you don't mind, Joe knows someone that had an extra $10,000 that they sent in on the mortgage. And the question is, so if I send in $10,000 in mortgage, won't that do the same thing? Won't that save me the same amount of money? It will not. Because if you send in an extra $10,000, they're going to take it off the bottom of the loan. So instead of owing, 103,966, you may owe 93,966. Okay. So Joe, this is a standard deviation. So we're going to set up 2 standard deviations, and I'm going to show you. It does save you money, but it saves you pennies. Does anyone have a calculator they can pull out for me and walk along? Okay, Lee. Okay. So let's say right now, I'm on payment number 5 on my amortization schedule. Wait 1 second, guys. And this is the last point I'm going to make, and then we'll yield the floor to Your Honor. Okay. Let's say that right now I owe $134,557. I send in an extra $10,000 to the bank. So first of all, let's do $134,577.76, Lee. That's my balance.
134,577.
Yeah, 0.76.
Got it.
So at a 3.5% loan, that's an annual rate. So we're going to take that times 3.5%, 0.035. How much is that?
47.10 and 22 cents.
$4,710.22 annually that we're paying in interest on that much money at 3.5%. Now divide that by 365 days. This is our daily per diem.
$12.90.
So we're paying $12.90 in interest per day on that balance at 3.5%, okay? $12.90. So someone just remember $12.90 in their head. Now, Lee, let's take that 134. Was it 134,557? Is that what you?
Yeah, that's what you.
134,557.82. And we're going to subtract $10,000 off of that. So it'll be 124,557.82 times 3.5%, 0.035,
43.59.52.
divided by 365 days.
$11.94.
Okay, so let's take 12.90 minus 11.94. Should be 96 cents.
96 cents.
Okay, so we're saving 96 cents a day in interest times 30 days of regular monthly payment.
96.
Times 30.
$28.80.
So we're saving $28.80 on the next month's payment.
Well, isn't your interest figured on the declining balance and not the annual balance?
Is it the declining balance from 134 down to 124? Annually, divided by 365 is your daily per diem. That's why each month your interest goes down and your principal goes up, because the principal that you're, and the interest you're paying on your principal goes down.
But you're figuring the 3.5% times.
The balance.
Yeah, the balance.
Exactly. Does that make sense, guys? Is that, I know we kind of went, it's a lot of numbers.
Kind of clear as mud.
Yeah, but guys, if you're going to send extra money in and you have $600 and you can pay 2 at $4.29, just pay the $4.29. If you pay the 3 and it's $6.45, pay in the $6.45. But designate it where you want it to go, and then you skip those 3 interest payments. You'll never have to make those. The bank will never collect them from you. The bank won't like you, but that's okay. And you can effectively turn a 6% loan into a 3 or 4% loan, depending on how often you do this and how many times you do it. Does that make sense? How much you send in and how often? Yes, ma'am.
Have they ever questioned you or called you or applied it wrong or?
Well, what you need to do is, guys, the question is, have they ever questioned you or applied it wrong? And sure, that's going to happen. But you designate to the bank what you want them to do, and they have an obligation to do that for you. There has been times when we got to the end of I'm selling the house, and I know what my balance should be, and they have a different balance, and then we'll go back and we'll reconcile our books, and we win. It's only happened twice, not one, both times. Yeah, because they have to apply that the way that you want to apply that. But if you just send it in, they're going to take it off the bottom. Save you 94 cents a day. You send it in your way, and you say $1,200 just in that one month.
I think you made the point, you gotta start that at the start of the amortization.
You do not have to start at the beginning of the amortization table, but you do have to know exactly where you are on your amortization schedule.
Right.
You know, you can start it on number 13, and then the 3 extra payments you pay are here.
What I
and
mean
then
is, let's say you pay an extra 10,000 on the second payment.
Okay, if you pay an extra 10,000 on the second payment, then you call your bank. Hey, I've sent in $10,000 principal payment, send me a new amortization schedule.
Okay.
And then you work from the new amortization schedule.
So you just ask them for a card, because I'm like him, I paid some extra, not your way.
Right.
But I'm somewhere in the middle of it.
Yeah,
you know,
yeah,
so-
just ask for a new amortization schedule based on the amount you owe and the rate that
In
you
other
have.
words, if you're here, they'll do an amortization table for
Starting there.
starting there, and it's 288 payments.
That's correct, that's correct. I hope that makes sense, guys. That's the way that you get one over on the bank. Not really getting one over, you're actually doing yourself a favor. Does that make sense?
So Roger, does that actually change your monthly payment then?
It will not change your monthly payment, no. It will not change your monthly, your payment stays the same, but what it will change is how far down you are, more goes toward principal than toward interest, the further you get down. 30-year mortgage on this loan, I have to pay 10 years and 3 months before I'm paying more principal than interest. And on a 6% loan at the same amount, you're 180 payments into it. 15 years is more heavily laden with interest. So anyway, I hope that's beneficial.
I was having a discussion with my son on the way over here, telling him this, so a way to show him that the bank's not applying it correctly would be to ask them how his last extra payment was applied.
Yeah, well, it's not that the bank's not applying it correctly. They're applying it correctly the way they want to.
Right.
But we want them to apply it the way that we choose to. They're applying it
How
correctly.
can I show him that it came off the bottom and not the top?
Yeah, I mean, yeah, so when it comes off the bottom, it's gonna ticker tape all the way up, and it's gonna be $10,000 less here. So his daily per diem is gonna be less, like we just showed, it'll be 96 cents less. But I'm happy to have a conversation with you further about this, and I'll send you that spreadsheet, Joe. Hope that helps you guys. It's very beneficial knowledge. It's great, great.